On November 8, 2016, in New Delhi, greengrocer Ranveer Singh heard that India's largest banknotes would die by midnight. He kept selling vegetables on credit because his customers had no cash. Then credit stopped being survival. It became closure. Later, the RBI record showed about 99.3% of banned notes came back. This is not fiction. This was India 2016. That last number is the fracture line. Because of almost all the banned cash came back into the banking system, then the first visible wound was not a mountain of criminal wealth disappearing in silence. It was a vegetable seller running out of usable money. Subhashri Chaudhary and Rajesh Kumar Singh, in Reuters field reporting from November 2016, found Singh doing what small traders do when the formal system suddenly fails. He extended trust. He let regular customers take food now and pay later. Not because he was generous in some abstract way, because the market still had people, still had hunger, still had vegetables. What it did not have was usable cash, and this is where the official story begins to crack. At the Podium, demonetization sounded clean. A strike on black money, a purge of fake notes, a national sacrifice against corruption and terror finance. But on the street, the policy did not begin by sorting honest money from dishonest money. It sorted people by liquidity. Who could wait? Who could switch? Who had a bank nearby? A working phone? Reserves? Customers who could still pay? Ranveer Singh had vegetables. His customers had need. Some of them may even have had money. But money that cannot be spent in time is not money in the way daily life understands it. It is a claim, a trapped claim. Reuters recorded Singh saying he did not have cash to refill stock. Before the crackdown, he had been making about $15 a day. After it, his problem was not investment theory. It was inventory. Food, family, corruption was real. Black money was real. Black money was real. But that is not the question this case exposes. The question is colder. When a state attacks illicit cash by breaking the usability of legal cash, who absorbs the first hour of pain? In New Delhi, one answer stood behind a vegetable stall. Then the stall closed. The order did not arrive first as a banking memo. It arrived as a national address. On November 8, 2016, Prime Minister Narendra Modi told India that Rs. 500 and Rs. 1,000 notes would cease to be legal tender from midnight, not next quarter, not after a transition period. Midnight. The Reserve Bank notice that followed cited the government notification and named the targets: counterfeit notes, black money held in cash, and terror finance. That was the official architecture. Moral enemy. Technical weapon. Immediate rupture. And if you only look at the speech, the policy has a certain brutal simplicity. If corrupt wealth is hiding in cash, then invalidate the cash. Force it into the banking system. Make people explain it. Let the illicit pile expose itself. That is the theory. But an economy is not a pile of notes sitting in a villain's cupboard. It is a chain of settlements. A vegetable buyer pays the greengrocer. The greengrocer pays the wholesaler. The wholesaler pays the truck driver. The truck driver pays for fuel, food, tolls, repairs. A small factory owner pays wages. A worker sends cash home. A landlord collects rent. A mother buys rice before the price changes. Each payment is small, but the chain is not. And in 2016, that chain still ran heavily through physical currency. Not because every participant was hiding wealth, because cash was immediate. Cash did not require a device, an app, a bank branch, a signal, or approval from a queue. Cash settled the day. That is the detail the Podium could not absorb. When the order arrived, it did not simply ask the corrupt to reveal themselves. It asked hundreds of millions of legal transactions to pass through a narrow administrative doorway at the same time. Banks had to exchange notes. ATMs had to be recalibrated. Customers had to stand in line. Sellers had to decide whether to accept old money, extend credit, or stop selling. Buyers had to decide whether to spend the small legal cash they had left, save it for medicine, or hold it for transport. The state had attacked hoarded cash, but street life needed moving cash. That difference sounds technical until you are Ranveer Singh. Because Singh's shop did not close because vegetables became illegal. It closed because the payment loop broke before the food loop did. And that is the forensic distinction. A policy can leave ownership intact and still destroy access. For Singh, that was not a temporary inconvenience. It was the moment the stall stopped functioning. Here is the hidden mechanism. Demonetization did not make every person poor at the same instant. It made millions of people temporarily unable to prove, transfer, or use the value they already had. Because when economists say the stock of money still existed, they are speaking from the balance sheet. The note could be deposited. The claim could be recognized. The value had not vanished in the abstract. But Ranveer Singh was not living inside an abstract. He was living inside a daily settlement machine. Vegetables arrive before they are sold. Wholesalers expect payment. Customers expect food. The seller needs cash from yesterday's sales to buy tomorrow's stock. The margin is small. The timing is everything. Break the timing, and you do not need to confiscate the shop. The shop stops breathing. A later study put numbers on what Singh felt at the stall. 86% of cash in circulation was made illegal tender overnight, while new notes entered gradually over the following months. But the sharper street-level number is even colder. Shodero Reich's CPR summary states that usable legal tender currency fell by about 75% overnight because the replacement notes printed at the time were equal to only about 10% of the pre-demonetization currency stock. 75%. Overnight. That is not a normal payment adjustment. That is a liquidity amputation. And once usable cash disappears, the burden moves to the weakest balance sheets first. A wealthy household could wait and still eat. A salaried worker could move part of the month onto a card. A large company could lean on credit. But a greengrocer has a different problem. He cannot digitize a pile of unsold cauliflower. He cannot ask a wholesaler to wait forever because a prime minister gave a speech. He cannot feed his family with receivables from customers who themselves are standing in bank lines. So credit becomes the bridge. For 2 days, Reuters reported, Singh sold vegetables on credit to regular customers. That sounds humane. It was also dangerous, because when a small seller extends credit during a cash access shock, he is not only selling food, he is financing the policy transition from his own working capital. The state created the gap. The shopkeeper carried it, and when his cash ran out, the moral language of demonetization became irrelevant. Singh was not hiding black money. He was not laundering cash. He was not funding terror. He needed stock. That is where ownership without access turns into closure. Money that arrives after payroll has missed its job. Not forever, just long enough. A cash shock does not stay in the marketplace. It moves. From the buyer to the seller, from the seller to the supplier, from the supplier to the employer. Then it reaches payroll. And payroll is where the official story becomes harder to defend, because wages do not wait for policy language to mature. In Ludhiana, Punjab, Reuters found Avtar Singh, the owner of a small auto parts manufacturer. Before demonetization, Singh had been trying to expand. He was applying to raise his credit limit from 15 million rupees to 20 million rupees. That detail matters. He was not shrinking. He was not fleeing the system. He was trying to grow inside it. Then the banking system changed its job. Banks that were supposed to evaluate credit were absorbed by currency exchange. Staff were processing old notes, managing queues, answering panic, rationing access. Singh told Reuters no bank was ready to give him a new loan because staff were busy exchanging currency. So the credit line froze, then the wage line broke. Reuters reported that 40 of Singh's 150 employees had stopped working after he could not pay all salaries. 40 workers. 40 workers meant 40 households recalculating the week: rent, food, transport, school fees, medicine. Not because demand had vanished completely, not because the factory had burned down, not because the workers forgot how to produce, because the payment system could not carry the real economy at the speed the real economy required. This is the second layer of demonetization. The first layer is Ranveer Singh's vegetable stall. Food moving through trust until trust runs out. The second layer is Avtar Singh's factory. Production standing still because banks, cash, credit, and wages all jam at once. And that is where the word cash becomes too small. Cash is not only a payment object. In a small firm, it is payroll rhythm, supplier confidence, worker attendance, creditworthiness, the signal that tomorrow's work will actually be paid. Break that signal, and the firm does not need to fail legally. It fails operationally. A worker who misses wages cannot treat demonetization as a patriotic abstraction. He still has rent, food, transport, remittances, school fees, medicine. The employer can explain the policy. The worker cannot eat the explanation, and the bank officer cannot solve it if the entire banking channel has been converted into a national bottleneck. This is why the damage appeared first among the honest. They were visible. They were local. They had payrolls, stalls, suppliers, and daily obligations. Hidden wealth had options. It could search for conversion routes. It could hire expertise. It could wait behind lawyers, accountants, property deals, gold, proxies, and layered deposits. But a worker owed wages on Friday has no shell structure. A greengrocer needing stock has no treasury desk. Avtar Singh had a factory. Ranveer Singh had a stall. Both depended on the same thing: money arriving in usable form before the day broke. Then came the number that should have changed the memory of the whole event. Reserve Bank of India. Annual Report 2017-18. After verification and reconciliation, the RBI said ERs 15,417, 93 billion in banned notes had been in circulation. The total value returned from circulation was Rs 15,310,073 billion, about 99.3%. That number changes the case. After the queues, the wage breaks, the credit freezes, the closed stalls, the stalled factories, the empty ATMs, the fear, the rumors, and the administrative exhaustion, almost all of the banned cash came back. That does not prove there was no black money in India. Precision matters here. It does not prove every returned rupee was clean. It does not prove illegal wealth failed to find conversion routes. It does not prove corruption was imaginary. But it does prove something colder. If the central measurable event was that about 99.3% of the banned notes returned, then the clearest confirmed burden was not the disappearance of hidden cash. It was the temporary destruction of usable cash for everyone who needed cash to live, trade, pay, and employ. That is the buried lead. The policy aimed at the invisible. The shock hit the visible first. Ranveer Singh was visible. Avtar Singh was visible. Workers waiting for wages were visible. Customers needing vegetables were visible. Their money did not have to be criminal to become impaired. It only had to be physical. India in 2016 matters because it exposes a pattern governments rarely advertise. Cash reform is announced upward, but it is absorbed downward. India is the case. Nigeria is the echo. In 2023, Nigeria's redesigned Naira notes produced severe cash shortages in a cash-dependent economy. People struggled to buy necessities. Businesses closed. The stated aim sounded familiar: curb illicit money, push digital payments, modernize the system. Different country, different design, same survival question. What happens when a government redesigns cash access faster than daily life can adapt? The official answer is efficiency. The street-level answer is the queue. And queues are never just queues. They're wages delayed, food delayed, stock delayed, trust delayed. The lesson is not that cash is pure. Cash can hide crime, move bribery, finance violence, and sit outside tax records. That part of the official story was not invented, but the forensic record forces a harder conclusion. When the state attacks illicit cash by breaking ordinary cash access, the first victims are often not the hidden actors with lawyers, buffers, and conversion routes. They are the visible actors with obligations due today. Ranveer Singh did not need a theory of monetary policy. He needed enough usable cash to refill vegetables. Avtar Singh did not need a speech about national sacrifice. He needed banks that could still process credit and workers who could still be paid. The survival lesson is not complicated. It is just usually ignored. First, do not confuse ownership with access. A bank balance, a wrong denomination note, a frozen payment app, and money trapped behind a queue are not the same thing in a crisis. On paper, they may all represent value. At street level, only one question matters. Can it settle what must be settled before the deadline arrives? Second, map timing before the shock has a name. For a household, that means food, medicine, rent, transport, school fees, remittances. For a small business, it means payroll, supplier terms, daily sales, loan renewals, inventory timing, and which customers turn into unpaid credit when payment access breaks. Because in a cash access shock, you may not fail from lack of wealth, you may fail from lack of timing. Third, build legal redundancy before you need it. Not fear, redundancy. Some physical cash in usable denominations. More than one bank relationship where practical. More than one payment rail, a way to receive and make small payments if one channel is frozen. A written rule for how much credit you can extend before kindness becomes insolvency. Ranveer Singh's first act was trust. He sold on credit. But trust without replenishment becomes extraction. The customer survives one more day. The seller absorbs the gap. Then the seller closes, and the neighborhood loses both food access and informal credit. That is not resilience. That is depletion wearing the mask of community. Finally, watch the language of reform. Currency redesign, withdrawal limits, anti-corruption drive, cashless modernization, temporary inconvenience, national interest. A policy can be necessary and still break the people least able to absorb the transition. But necessity does not erase sequence. Ask the forensic question. Who loses access first? If the answer is wage workers, street sellers, small manufacturers, rural households, pensioners, and people far from formal banking, then the policy may be technically elegant and socially violent at the same time. Both can be true. India's demonetization did not end with the disappearance of most banned notes. The RBI record showed that about 99.33% came back. Nigeria was not the same event, but it carried the same warning. When governments redesign cash faster than daily life can adapt, queues become an economic instrument, not a side effect, an instrument. And in every version of the story, the official narrative looks upward, to corruption, to modernization, to national discipline, to the future. But the first truth appears lower. At the stall, at the wage counter, at the ATM line, at the shop that cannot reopen because yesterday's legal money no longer arrives in time. So the binary choice is simple. You can treat cash access as a minor technical detail, something for bankers and policymakers to optimize after the announcement. Or you can treat it as survival infrastructure. Ranveer Singh's shop shows the cost of choosing wrong. The money came back. The day did not.